The structure of the crypto market. Let's break down how the crypto market actually works. Because to trade at a higher level, you need to understand the structure behind the price. In traditional markets, price reflects human behavior filtered through exchanges, brokers, and settlement systems. Crypto works the same way, except here that structure runs on code, data, and a 24 by 7 heartbeat. So, who really moves the market? What drives price discovery? And where do the inefficiencies hide? Let's dig in. The market microstructure. The crypto market is not one big unified place. It's actually a network of smaller markets. Each exchange is its own little world with its own liquidity and psychology. Binance, Bybit, Coinbase, OKX, Uniswap. All of them have different traders, different flows, and sometimes slightly different prices. For example, Bitcoin might be trading at 68,030 on Binance, 68,045 on Coinbase, and 68,060 on Bybit, all at the same second. That's what we call fragmented liquidity. It sounds messy, but it's also an opportunity. Those small differences create arbitrage windows where high frequency boards and institutions make their money. Spot versus derivatives markets. Most people think of the crypto market as buy Bitcoin, hold, and sell higher. That's spot trading, but it's only a small part of the real picture. Spot volume makes up around 25 to 30% of all trading. The other 70 to 75%. That's derivative, mostly perpetual futures or pubs. Pubs completely change the game. They let traders take leveraged positions without any expiry date, but they come with something called funding rates. When longs dominate, funding turns positive. Longs pay shorts. When fear takes over, funding flips. Shorts pay longs. This constant push and pull between spot and derivatives demand is what drives short-term price discovery. How price discovery works. Price does not move randomly. It moves where liquidity is not. Every candle you see on a chart represents a hunt for liquidity. When a big player wants to buy or sell, they don't drop the whole order at once. They split it across exchanges to reduce slippage. But as those large orders interact with market makers, they create the patterns we recognize: fake outs, breakouts, and those painful stop hunts. For advanced trader, this is the real battleground, the microsecond tug of war between liquidity seekers and liquidity providers. The role of market makers. Market makers are the invisible architect of the crypto price movement. They are the ones constantly placing buy and sell orders around the current price, earning from the spread, not from the direction. Most of this happens through algorithms. Firms like Wintermute, Jump Trading, and before its collapse, Alameda Research run systems that quote prices across dozens of exchanges at once. They earn fractions of a percent per trade, but when you do that billions of times a day, those fractions add up fast. When volatility spikes, market makers widen their spreads. Liquidity thins, prices move faster. That's why slippage explodes during crashes, not because people stop trading, but because liquidity providers pull back. If you can track that liquidity behavior using tools like order flow, heat maps, and depth chart, you can often spot where the next move is going to start. Centralized and decentralized exchanges handle liquidity in completely different ways. On a centralized exchanges like Binance or Coinbase, liquidity sits in an order book. Buyers and sellers post bids and asks, and trades happen when they match. You can see where the orders are stacked on a decentralized exchanges like Uniswap. Liquidity lives in pools controlled by the smart contracts. You are trading against an algorithm, not a person. That's called automated market making, or AMM, based on the formula X times Y equals K. Centralized exchanges liquidity is deeper but less transparent. Decentralized exchanges liquidity is shallower but completely transparent. You can see every swap, every wallet, every whale move right on chain. For advanced trader, combining both gives a serious edge. Centralized exchanges data shows speculative positioning. Decentralized exchanges data shows real accumulation. Liquidity, volume, and volatility. Liquidity is the lifeblood of every market. Volume tells you how much is traded. Volatility tells you how fast it's traded. Liquidity tells you how easily it's traded without moving the price too much. Even if Bitcoin trades billions per day, most of that might just be derivatives churn. Real liquidity can still be thin. That's why small changes in demand can trigger huge moves. Professional traders track liquidity metrics like bid ask spreads, market depth, and delta volume to find thin zones where stop hunts or breakouts are likely. Those liquidity voids, low volume areas, often act like magnets for price. Liquidity doesn't just fuel the market, it maps where it's going next. Stable coins and market health. If you want to go bit how much real liquidity is flowing into crypto, look at stable coins. When USDT or USDC supply increases, that usually means new money is entering the market. When the supply contracts, liquidity dries up and the risk appetite fades. We have seen this play out before. In early 2021, stablecoin issuance surged right before Bitcoins run to 60,000. In mid 2022, contraction signaled the downturn that followed. Stablecoins are crypto's shadow money, the digital dollars that power every trade. Tracking their movement across chains can show you markets' health before prices react. Institutional influence and market evolution. Crypto is evolving fast. Institutions are now deep in the game, trading derivatives, options, and even ETFs. And that changes how the market behaves. Volatility is lower, correlation to equities is higher, and moves are often more strategic than emotional. By 2025, Bitcoins trade less like a retail asset and more like a macro instrument. Liquidity clusters from around level where the institution has, not where retail traders speculate. Understanding this shift from emotion driven moves to structure driven liquidity is key to staying ahead of the crowd. Alright, let's zoom out for a second. We have covered a lot from exchanges and liquidity to derivatives, stable coins, and institutions. Now it's time to tie it all together. To master the crypto market, you need to think like an engineer, not a gambler. See the flow, not the noise. Price is just the output of structure, and structure is where you as really lives. See liquidity, not candles. See behavior, not headlines. That's how you truly understand the crypto market from the inside out.